All righty, ladies and gentlemen, welcome to episode 23 with Jennifer McGuinness, who's the CEO of Pivot Financial, a leading firm reshaping mortgage finance through innovation in capital markets, aggregation, and servicing oversight. With more than 25 years in mortgage banking and structured finance, she has led major initiatives across lending, securitization, and asset management. Before Pivot, Jennifer founded and led Invigorate Finance and Mortgage Venture Partners and held senior roles at Colony American Finance, Premium Point Investments, and Windwater Home Mortgage. Oh, man, I forgot about Windwater. She also led the first hedge fund issued AAA rated RMBS backed entirely by new originations. Recognized as Housing Wire's Woman of Influence and Vanguard Award winner, Jennifer is known for her pragmatic leadership, innovative mindset, and deep industry insight, which is what ChatGPT came up with for you, Jennifer. I also will add, I think, one of the most honest and open voices in the industry. But on that first part, Jen, how did ChatGPT do?
I don't know, but you know me,
Anything wrong?
so it was a little weird that you were reading that. ChatGPT did okay. I think, at the end of the day, what it should tell you is no matter what my titles have been and what organization I've been sitting in, whether it's a bank, a REIT, a fund, a lender, etc., my job roles have been the details. And, that's what I do, and that's what I usually talk about in these discussions. So I'm looking forward to this one. I've got a trifecta of Q&A going on.
We all are very excited, including people who are watching. Anybody who's watching this, if you want to ask Jen a question, jump right in. Jen, I have to ask you a really quick question because you and I have known each other for longer than you wanted to. And I always refer to you as Jen McGuinness, and I don't ever use your new last name. Is that okay, or do you go by Jennifer McGuinness-Lubbert?
No matter what my name would be, everybody refers to me as Jen McGuinness, and there's nothing wrong with it. So we're good to go.
Okay, that's fair enough. Okay, so our first question always, Jen, for everybody is nobody grows up going, I really want to be in mortgage finance. I can't imagine that 5-year-old Jen was all excited about mortgage-backed securities and asset-backed lending. Do you remember what you wanted to be when you grew up, when you were little, out of curiosity?
Well, I mean, I could tell you what I wanted to be before I ever got into finance. So I was actually a classically trained opera singer first. I went to a music and art and performing arts high school, sang all over. I grew up in New York City, and literally my high school was right behind, Lincoln Center. And then I went to music conservatory before I ever went and got my regular undergrad, which then, led to this career. In some ways, my career in this industry was a happy accident. When I decided I wasn't going to sing anymore, I went back to, I kind of was still in school and I was going to be a lawyer. And, candidly, I graduated early and had 6 months before I could take the LSAT, got a paralegal degree, started working in the law firms after being an underwriter and a processor for mortgage companies in college to pay the bills. And away we went. I got into law school 3 times. I never went. And one of the reasons for that was I kept getting promoted in this jazz that we're in still today. So I bet you've never gotten the classically trained opera singer answer, Andrew.
I didn't know. How did I not know this about? Again, I've known you for like 20 plus years, and I had no idea that you were a classically trained opera singer.
Well, I mean, when you're talking about due diligence and, mortgage structuring and resi securities and all that fun stuff, I doubt that, hey, by the way, were you a classically trained opera singer comes up. So, I think it's been mentioned, I know, in some interviews that people have published about me, but I don't think it's widely known, but now it is.
There you go. Now I'm learning all sorts of things. Now the lawyer thing I get, like knowing you long enough, like that I could have seen. I could definitely see you going that route for sure.
What kind of law would you have wanted to go into?
I originally wanted to be an M&A lawyer because I thought on the merger and acquisition side that the lawyers were the ones negotiating the deals. I learned rather quickly that it's not the lawyers that negotiate, it's business people like us, and then they partner with the lawyers to document. So, in the long run, I think I got the job I wanted, just different. And yeah, but I got in a few times, just never went. It's funny. I work with a lot of lawyers, and they always tell me, "Oh, that's a good thing that you never went." So, I guess it is. Yeah.
They're telling you would have been a good litigator. That's what they're saying.
I've been told I would have been a good litigator, a good criminal defense lawyer, very detailed. Like I've been told a lot of things over the years, but at the end of the day, I've chosen to deploy my expertise and time and tutelage on the mortgage industry.
I love that Andrew mentioned the AAA mortgage backed, and then also you said you'd be a good criminal defense.
I think, let's simmer down on the criminal with the bond business. There's nothing criminal about having structures for recycling capital.
Listen, all I know is if I was convicted or if I was accused of a crime, like I want Jen in my corner, like in a courtroom. Like I just, so. Okay, so you didn't go law. The opera didn't extend. You ended up in finance. And you have had a story. I mean, you really, truly, all joking aside, you have had a storied career so far and lots of years to go. But let's talk about financial specifically, because I think there's a lot of different things you guys solve for, but you are a little bit different. You're not run of the mill, if I may. Talk a little bit about what Pivot does and what you guys are solving for and how you're different in the space.
Yeah, so I think, I'll tell you that in 1 second, but I think if you know me and you know my career, I started first originating loans, then went into legal and did the not so happy side of lending. So foreclosures, bankruptcies, REOs, evictions, and a vast array of complex litigation, both debt and equity for resi and commercial. And then, built a servicer that was also an acquisitions business and ran, everything from special situations, loss mit, all the way to document control, escalation for acquisitions, et cetera. And then I was in the investment banks. I was the asset management at Deutsche Bank and, also breach of rep and warrant there. Worked on the RMBS book of business. We also did the first Ginnie Mae reverse mortgage securitization. And then I was in the hedge funds and the REITs before I started this business. So when you really think about that, and the reason I give you that background is because understanding Pivot then is a lot simpler. It's really a full life cycle background that I've been blessed to be given the opportunity and earned the opportunity to learn, from origination, servicing, asset management, and structured finance all the way through liquidation. And that's really why I built Pivot. I got really sick of building multi-billion-dollar trades, because that's what we do in banks. We get an allocation in a bank, we raise capital in REITs, hedge funds, we buy stuff, in the acquisitions businesses, et cetera. But when you're, initially raising capital from, institutional investors, you'll find that they want to narrow that strategy, as to what you can do in those investment vehicles as much as possible. By doing that, though, they don't necessarily take into consideration when the market can move and change. You kind of have to go back to them and have a totally different conversation. So I wanted to build an operational platform that could proactively react to the market, everything from acquiring loans all the way through liquidating them. And because everybody else does it with a bunch of vendor partners and a lock engine, for example, on the loan acquisition side, and nothing else. So we truly have an operational platform. We are capable of acquiring loans, servicing loans, administering them, complex asset management, litigation support, breach of rep and warrant, and repurchase defense, et cetera. And that's what we do day to day. So a lot of people say, hey, that's a lot. It's not. If you really are not a siloed player, you will absolutely understand that that is just the life cycle of the mortgage loan. Mm-hmm. And that's what we do. And that's what we do best.
Do you guys typically work with mid-sized lenders, or where do you guys kind of plug in? What's your guys'
Our client base goes from a smaller lender all the way up to the top 10.
And they rely on you to essentially manage all of those verticals that you talked about or parts of the process?
It depends. So we're not solely a vendor, right? So we have two legs to our business. We have an aggregation business where we buy newly originated loans to the specification that we want to buy. And then on the asset management business, we have, the loss mitigation oversight group, and the asset manager. And also, like I said, breach and litigation support. So you want to know how our relationships usually start? They usually engage with us for one thing. They find out how good we are at that, and then it turns into a whole bunch of other things that we then partner on. And I think that that's, the key component, Pramod, right? We are an efficient partner for lenders, funds, REITs, warehouse lenders, et cetera. And I think that that's important. One of the things that I really think sets us apart as well is lots of different types of counterparties are always generally involved in negotiating deals. One of the things that my team can do is literally sit in a room and be like, that's going to work for them, but it's not going to work for you. And the reason it's not going to work for you is we need to make this tweak for it to work for you. You agree that it works, right? Then you go to the next guy and boom, 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 and it expedites conversations and execution exponentially. And what that does is it saves you money and also makes you a lot more money. Right? You're not wasting time on minutia that's unnecessary, exploring theories when there's finite answers.
Gotcha. Also, I got 1,000 questions, but going back to what you said about the $1 billion trade. So basically, just so I understand from a structural perspective, like the banks say, hey, we want to originate, I don't know, $2 billion worth of loans, or we want to structure a trade like that. They put up the capital, and then you would go acquire that from a bunch of banks, or sorry, mortgage banks.
It depends. Are you in the investment bank or are you in the branch-based banks, right? So, large banking institutions, let's use the money center banks as an example, right? Will have their own lending businesses where they go either direct to consumer or direct to call center or multiple channels, right? And they'll originate loans themselves. The investment bank itself will generally partner with some of the largest lenders or other types of entities to bring them in sizable amounts of loans. And then you're trading with multiple counterparties, whether they're the direct lender or an aggregator, so that you can aggregate more quickly to then recycle that capital over and over again. Now, in an investment fund, it's more important to recycle that much faster because your yield or return profile expectations are so much higher, right? Than, if you're using your own balance sheet. But also, think about the headlines you read about every day. Are you a bank? Are you a fund? Are you a REIT? Are you an insurance company? That's a big one in the business today. Everybody's saying insurance money is the way to partner. And that's true and false, depending upon who the counterparties are and what the structures are, right? So I think, again, it's where you sit and how the structure is set up as to who your counterparties will be.
I see.
All right. So let's jump into the tech space because I know you don't have any strong opinions around AI at all. As I've heard you talk on stage a few times so far this fall. So I want to go a little bit broad and then we'll get a little bit more narrow, right? But the first thing, you asked me a great question probably a month or two ago, is you said, what do you guys do when the AI gets it wrong? And it was funny because I didn't say this in the moment, but I thought about it afterwards as I was like, well, what do you do when the human gets it wrong? Right. So we have this expectation for technology to be perfect. Right. So like I've always thrown this out there, like if you could have self-driving cars and you would only have a 1% chance of getting into a car accident, or you could drive your own car and you have a 6% chance of getting in a car accident. Most people will tell you that they want to drive their own car because they truly believe they're not in this, because they don't think they're in the 6%, right? And so they're not willing to put themselves at the risk of the 1%, right? And we know that knowledge workers are generally speaking are wrong somewhere between 5 to 10% of the time. Now, it depends on what we're talking about, obviously, from that perspective. So I want to kind of take that question that you asked me and ask you, like, where do you think the tolerance is, and how do we approach this as we continue to see more and more AI roll out that's not necessarily going to be 100% 100% perfect?
So I think we need to be careful on what we really call AI. I think AI, very similar to the word machine learning, is overused. And not every, product or business line or offering is truly AI, right? So I think that that's important. And I think once you start to delineate that, you can then peel the onion back faster, right? So, let's use ChatGPT because you used it, from my background, okay? ChatGPT is only as good as the sourcing that it uses in order to return a result, right? And
Right.
generally, when you look at a ChatGPT or a Copilot or one of these, it tells you what the sources are. So when you start to really ask it questions, right, it's only as good as what it can pull from. So ChatGPT is a great example. There's a lot of litigation, for example, pending for, copyright violations and things like that, where people believe that they should be buying certain data in order to return their results, right? So in a very generic, Jennifer McGuinness kind of lookup on ChatGPT, again, it's going to be, what are they scraping? Where's it coming from? Is the source good, et cetera? Well, it's going to be the same thing when you start to ask them other questions. For example, what does regulation blah, 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 blah say a lender needs to do? Well, it's only going to be as good as the sourcing it can find, either on the fly based on its algorithms or what it's been taught. Okay. So the more that you teach it AI, real AI, right, the more you can rely on it. Okay. I think one of the things we talked about, and Andrew, you were there, you were on a panel, I was on a panel, was at the Mortgage AI conference, right? Is great example, automating underwriting. Okay. It's only going to be as good as how much you teach it. It's only going to be as good as the outcome you're seeking. A lot of AI, and when you listen to the AI guys talk a lot, and you're one of them, so you can tell me if you agree or disagree with this, is LLM this and LLM that, okay? Large learning model. Well, the crux of an LLM, large learning models, data models, right, is it's really a statistical modeling tool. And then you can teach it to answer questions, okay? If you teach it correctly, you can get high outcome certainty. If you leave out important components of what it needs to know in order to answer the question correctly, it's going to return the wrong result. Debt to income ratio, great example. Not all lenders calculate it the same way. And debt to income ratio is not only truly the income being used to underwrite. So for example, even a consumer facing underwrite, you'll have a debt to income ratio, but part of that income could be rental cash flow. And there's a different method by which to determine what component of that income and what the dollar amount is for rental cash flow, right? You may have a borrower who's W-2 and self-employed. So you may have W-2 and 1099, all different calculation methodologies, right? And then the sum total of all these different calculations come into this one income number. So if you just say, take income and debt, do the math, and here's your percentage return, what's it looking for? For borrower A, it may be looking for 4 things. For borrower B, it may be looking for 1. For borrower C, it may be looking for 2. You see where I'm going with this, yes?
Oh, 100%. And it largely, and Mace, you can jump in here as well, is, it does come down to what knowledge are you siloing, but it also comes down to what is the prompt, right, that's behind it, right? So Chris knows this. Early on, we were talking about this, and I give you an example in our own system is you can ask the question, what is the max LTV on a DSCR loan? That is a loaded ass question, right?
Yep.
Because technically the answer might be 80%. Well, but were you talking about a refi with a $2 million loan amount with a 680 FICO? Because in that instance, it's actually 70, right? So you also have these context components. And if you don't design the prompt behind the scenes to give you additional information when it knows, hey, this is a little bit of a more general question, you've got to design it in that manner, right? But ChatGPT is not taking that into a case, because ChatGPT, and I think this is a big thing for me, is ChatGPT is a B2C platform. It is not a B2B platform. And I personally get frustrated when people talk about like, oh, we're using ChatGPT. And I'm like, you shouldn't. Like, we all know the case of the lawyer in New York who got disbarred because he used ChatGPT to come up with case law. Well, the problem with ChatGPT is it's trained on every law textbook ever written. It's also trained on every John Grisham novel and episode of Law and Order, right? So it's naturally going to get confused. Also, like you just brought up a reg example. I can't remember the exact reg, but I was like testing this out on ChatGPT, and it turned out that the Department of Labor has a reg that's the same number, like digit and alpha numeric as a reg in the CFPB. So I asked the question about a reg, thinking CFPB, looking for an answer, and it came back with the Department of Labor answer.
Right, but that's why people need to remember, and I'm going to say something that's probably blunt, but that's me. Don't turn your brain off because you're using a decisioning engine, right? Like, you don't just take at face value what ChatGPT is telling you. If it's returning you a link to the actual regulation, open it up and see if it says what the alleged summary is telling you, right? And I think that that's important, especially in legal work. I mean, you just saw a $440,000 refund from one of the largest, external companies that do consulting be put back because their report was written by AI. I mean, that's insane. Anybody who's blindly relying on this,
right?
Yeah, I mean, I'm not going to call them out, but if you choose to.
I will. It's fine. I wanted a T-shirt that says "Don't be Deloitte."
Right, but my point at the end of the day is, believe what you believe you should believe, but don't be stupid, right? If it looks too good to be true, it probably is. And then also look at what the sourcing is. Is it, somebody's opinion paper from, 1998? Or is it, a real source with real information that's done real testing, etc.? So I think that's important. I'll give you a good piece of humor. I ran a test on some of this stuff, and I did it for another conference I was speaking at, right? And I asked, who's the biggest mortgage lender in Michigan? Neither Rocket nor UWM were actually returned to me by any of the AI engines. Any of them.
Because they're
Does
technical.
that not seem odd? So again, take it with a grain of salt and realize if you're using real tools, not just the free ones, that's only as good as how you train it, the information you give it, the way that you ask the questions, etc.
Yeah, I think, Andrew, whenever you were going down the first endeavor, one of the things I kept saying was like how you can get the model to try and ask you more questions the moment it feels like it doesn't have a confidence level. But like Jennifer said, like you just gave these complex scenarios, and getting the model trained to be like you have to train the GPT to be like, you need more info. Like if you don't feel a confidence level of here, keep asking questions.
Right.
And I think the SLMs are much more catered and tailored for this space. Like there's no need for an LLM in this space at all.
I don't know. I'm gonna agree and disagree on that one, Chris, because look, there are things that are finite in mortgage, right? That are absolutely check boxes, and then there are things that can change them, right? So I think, there are times that the more complex questions, compare this, compare that, compare this, compare that to get to an outcome. I do actually think you need something more robust, right? That's just an opinion.
I want to ask a little bit, something that would be a fun topic, if you don't mind exploring a little bit more, is repurchase defense.
Yep.
Can you talk a little bit about what, just describe maybe some scenarios or some stuff you do in that, like just maybe the last year or two, that's things that have popped up.
So repurchase defense, for those who are listening who don't know what it is when mortgages are bought and sold, reps and warrants are, given to those who are purchasing, and then also step down to when bonds are created by issuers. They can be, structured in many different ways, but, let's use loan level reps and warrants as an example. There are certain reps and warrants that are made with regard to loans. For example, they meet the underwriting guidelines, or they have documented compensating factors that are reasonable to not meet the underwriting guidelines. And I'm not giving you all the legalese from the agreements. I'm giving you the quick and dirty version, right? Mortgage loan fully dispersed. The appraisal was done in accordance with the proper methodologies, right? You met regulation. You guys get the point, right? Well, then there are the rights that the party who will use just in a buy and sell kind of scenario. I'm selling a bunch of loans to a counterparty. I make reps and warrants regarding those loans. Let's say that I say they meet the underwriting guidelines. The counterparty then reviews the loans, and they say, we don't believe that it meets the underwriting guidelines for income or assets or the valuation, amongst other things. Okay. Could be something as generic as the loan was an early payment default. Could be something as complex as, the borrower was never a citizen of the United States, right? I mean, it gets very, very broad. So we work in concert with lenders to defend against buying loans back. We also, at times, work in concert with the parties that buy loans to get their money back, right? I think that that's important. What I will tell you is on the breach defense side of things, we see a lot of claims that absolutely should never be made. The loans are not breach.
Can you explain some of those scenarios?
I'm sorry?
Can you explain some of those? Like, what are the top scenarios that are coming across that shouldn't?
For example, on appraisals, if it was C4 collateral, the large majority of the time, the counterparties will come back and say, no, this loan should have been classified as C5 or C6, which makes them ineligible for financing, right? And, there are details behind what classifies loans into each of these condition or quality categories. And then, a lot of it at the end of the day can also be based on opinion. But what you get usually in a repurchase request is something broad brush, like, this was C5 and C6 and not C4. I think one of the ones that's annoying me a lot lately is there was something originally referenced in the origination appraisal. The appraiser made it subject to. That issue was cured. A 1004D or, completion certification with documentation was obtained to show that it was cured. And then the counterparty is saying, yeah, but you should have gotten an inspection to further look into it. Well, the appraiser didn't say that they felt an inspection was necessary. They said that they felt that something needed to be fixed. Again, it's broadening something that shouldn't exist. And the loan technically meets the guidelines with that 1004 completion cert. Another good example is, mortgage insurance rescissions are on the rise again for certain allegations. Income, there's a lot more fluctuating income or multidimensional income in certain product types. And candidly, some of the aggregators don't understand their own guidelines as to what they asked for. And certain lenders, honestly, don't always calculate it correctly either. But, once it's, in all things income related, there are generally tolerances, right? If it's not perfect, but when you redo it, it's within X tolerance level, it's not breach, right? So there is a lot of detail and complexity to these issues. Sometimes it's litigation. There are allegations of fraud. Well, allegations of fraud and fraud are two very different things, okay? And I mean, even if you just look at some of the headlines we've seen lately, like, the Fed governor being accused of fraud, you saw judges in headlines very clearly say it's not fraud unless you could show she intentionally did it, right? So there's a lot of, nuances and details to this stuff, but basically it's going back and being able to either A, prove that the loan truly is breach. So that's number one, or prove that it's not, and then make the argument to be able to have the repurchase demands withdrawn.
Okay, so on that topic, I believe I think this came up last week, but if I remember correctly, Fannie Mae is inked a deal with Palantir. Is that correct? Tell me if anybody thinks I'm wrong on that one, but I believe it was Palantir, who's going to build out all of these AI systems to help them with with fraud detection and repurchases, right? So now we're going to have AI scanning all of Fannie's loans to determine which ones should go for repurchase. Thoughts on this one? Anyone can jump in.
Again, it's as good as how you train it, number one. Number two, credit risk assessment historically has been based on also the performance of the asset. Mm-hmm. It is ridiculous if a loan has perfectly paid for 5 years for you to ask to repurchase it if for some reason something at origination seemed off. Agreed. 5 years later, right? But that is happening every single day today.
I would argue 12 months. Like, I getting a little bit away from the question. I have still never understood, like, in my opinion, 12 months of 0 times 30, like that loan should be safe harbor at that point in time.
So if you look at, life of loans, right? No matter what loan, no matter what product, no matter what structure, loans in general live weighted average life 7 to 11 years max. I don't care if you're a 30-year, a 15-year, a 40-year, that's what you got.
Right.
Okay. When you're sitting in a scenario and you have a 5-year perfectly paid loan and somebody puts a loan back for an alleged misrepresentation from origination, that borrower could have had 2 different jobs by now, could have had a bunch of different things happen, right, since the origination of this loan. So to actually be pointing back to income or assets or whatever from 5 years ago, well, if they didn't have the income and the assets, how'd they pay you for the last 5 years?
Right.
Like, there has to be a common sense application to these things. And then the question is, when is it an origination issue and when is it a life event, right? And I think that that's important as well. Generally, even on an owner-occupied property, GSE, right? You can take out a primary residence loan, and if you have an extraordinary circumstance and you don't move into that house, you have not necessarily committed misrepresentation. Well, if that can happen for the entire type of loan, how is it that 5 years later in perfect paid status, you don't know that the income and the assets from origination really has no context to where this loan lives today, right? And the borrower's paying. It is a good credit risk holding in general. Back in the day, people really only put loans back once they defaulted, and that's when they did the breach of rep and warrant reviews. Look at the automatic breach reviewer structure in AAA rated residential mortgage-backed securities today. They're not looking at every single loan. They're looking at the loans that have either issues or defaulted or have liquidated. Right?
Well, I thought it was like 90 days down. Like, you don't even look in the security.
90+ years delinquent, but with XYZ characteristics and risk profile, right?
So what happens?
It's a risk test. It's not every loan.
But now what happens to the market, right? Because where my concern becomes, right, is Palantir comes in. They don't know the industry, right? AI is already, it's like we don't know what it's going to be trained on. And not only what it's being trained on, but also the fact that it's constantly updating, right? So like if you think about it, is I deploy AI, right? And there's a lot of really smart people at Palantir, right? But now I'm looking at loans over a wide swath of origination dates, right? And now how does the engine know what to apply across each date? It's going to be a difficult thing to build out.
Well, I mean, just like we see it all the time, the counterparties forget about lender letters that were put out during COVID. They forget about guideline revisions. They forget that they're supposed to be looking at guidelines from, 2020, not 2025, and stuff like that. So to your point, Andrew, if you don't train it, right, and you're not looking at the right and the relevant information, it's not useful.
So how do you feel like this ends up ultimately impacting because the market? Because I get the sense, and granted, this is just this is just an opinion, that the agencies are going to get more difficult in this arena, not less difficult, as it comes that they deploy more and more AI tools to look for repurchases and quote unquote fraud, right? Do you think, and where I'm going with this is because both you and I are big fans of the non-QM market, is do you see this, if Fannie does become difficult, do you see this in some ways boosting the non-QM market potentially, as maybe the secondary market becomes easier to work with than the agencies?
Yeah, the one thing I would say is you keep saying Fannie only, but let's keep Fannie and Freddie in play on this discussion.
All right, you're right. My bad.
So, the answer is yes, right? And I think you've already seen it happen. I mean, over the course of the last 5 years, for example, non-QM went from 2% of originations to 8% of originations. That still means that 92% of originations is, GSE, Fannie, Freddie, FHA, VA, blah, blah, blah. But, you've had a quadrupling, right? Wait, like, you're over 8% at this point. So I think that's important. I do think you're going to see the rise of prime non-agency products again. You already see jumbo, right? And I think you're going to see midline credit non-agency products again. Non-QM gets a little bit of a bad name because everybody thinks it's always bank statements and 1099 loans. There is straight up, right out of agency box non-QM, standard tax returns, asset statements, et cetera, as well. I think that, the market needs to do a better job of pricing that risk. It's less risky than it prices today from a bond execution perspective, as an example. I recently did, and I'm sure there'll be a run on Washington to my LinkedIn profile once I say this. I recently answered a question, actually Pramad's the one that called me out to answer it, about, is non-QM dangerous? Is it going to be the next thing to, bring us another housing crisis? And the answer is no. If you actually look at the characteristics of the loans in the non-QM market that are originated, at times they are a lot less risky than the GSE loans themselves. The other thing I would point out that nobody focuses on, non-QM loans, when due diligence is completed, whether it's in a sampling or 100% due diligence model, the due diligence is done by a third party. Okay, so it's done by a rating agency approved due diligence company. Right. The GSEs are not subject to the rating agency approved due diligence company or the due diligence of a third party at all, unless they're doing a stacker or another risk sharing deal. They themselves do their own QA/QC internally. Whether they use vendors or not is what it is. But my point to you is, why is that allowed for the GSE when it's not allowed for anyone else? That's not right either.
And also, I'm sorry, I don't play in the government, so I guess it's okay if I get in trouble, whatever. But you even, and I know that the requirements around stagger deals are kind of a joke comparative to a non-QM rated securitization.
Yeah,
the diligence is so skinny.
But again, think about this. You now have the government owning, for the moment, the majority interest in these businesses, right? Why are they not subject to diligence? And then why? We have an implicit guarantee behind, the GSEs. There is no guarantee. It is implicit. It's all based on lines of credit from the housing crisis when they were taken into conservatorship. But at the end of the day, the too big to fail is really what gives you that implicit guarantee. So my question to you is, why is it okay for the large majority of the loans originated in the United States not to be subject to third-party diligence? The whole reason why that process was created was because the market did not want the same people in the aggregators to be looking at the loans. They wanted diversification of the parties looking at those loans to really understand risk. That's where the grading methodologies came from. That's where the rating methodologies came from, etc. So why is GSE paper seen as better paper when it has the least amount of due diligence conducted on it in the entire market by anybody except themselves?
Well, why do SEC rules not apply to the agencies, but they do apply to everybody else, right? So if you look at, if JP Morgan decides to go do $250 million securitization tomorrow, and Fannie Mae decides to do $250 million stacker deal or their own securitization, the rules of engagement are completely different. And JP Morgan, by the way, pays twice as much money in diligence as the agencies do.
Yeah, so there's some nuances of that stuff, but you're right. The GSEs should have to meet the same standards as any other aggregator in the market. And that is how you get what's everybody's favorite word right now: competition, fairness, equalization, continuity, right? That is how you actually get a dynamic and strong housing market.
Agreed.
Quick question. For those who don't know, aka me, what is the stagger deal you're referring to?
So it's a
Could you
risk share
explain?
transaction where certain loss related items are shared across differentiated counterparties and not solely held by the GSE.
Got it. Okay.
So you're investing in the risk. Okay, pivoting from there, back to AI. Where what?
I love the finance talk.
Where I know, ex Goldman guy. So all the talk about AI, all these conferences that we go to, most of the vendors that we see out there are very hyper focused on front end originations, right? Like these guys know I made this joke about the Housing Wire AI summit where I felt like every other person I bumped into was building the next AI POS or the next AI LOS, right? And granted, there are some people building some cool stuff, but it just seemed like that's where everybody's attention is. And generally speaking, at least I have found is there's always a lag for technology on the secondary market. So what I'd love to hear from you as someone who is kind of on the forefront of this is, where are the spaces, or where do you feel like, knowing where AI kind of is today and knowing where the secondary market is what are the problems that you feel like can be solved on the secondary side by AI that nobody is touching right now?
I think there are people attempting to touch a lot of things or saying they're touching a lot of things, if that makes sense. But again, I'm going to go back to what I said before. What's really AI and what's really a, filtering engine, right? And I think that that's important, right? Certain of the platforms that are marketed as AI are really no better than a dynamic pivot table, right? In Excel, or an Excel VBA if statement, right? I mean, and I think the market needs to get there. They need to learn the difference. I'm going to get yelled at by a vast array of vendors for what I'm about to say. Lenders, if you are talking to vendors about helping you with your AI, ask them what gives them any level of artificial intelligence. How are they searching for these queries? Do they have machine learning capabilities? If the machines can't be trained, you can't have intelligence, right? The other thing is if somebody says that they are a machine learning business, how big is their lab and how many computers are in it? You can't do machine learning without a crap ton of machines with big processing power. And I think the sooner that everybody has like that come to Jesus, the sooner we'll get the people that are really going to help bring the market forward, identified, brought to the top of the funnel, and then away we go. To answer your question, I'm sorry, Chris, did you say something?
No. I was like, my name is Chris Mason. I approve this message.
Yeah.
Like it's funny when we got our grant from AWS, they had an interesting conversation. Was like, so like great, like if you just do this part, you can say that it's using our Amazon Bedrock, and you get like the AI you can put on your website and stuff. And I was like, what the fuck? No, like we want to keep going. Like we want to do the whole thing. He's like, oh, cool. He's like, some people just try to do the bare minimum to where they can get an AWS stamp that says it's using their Bedrock and using their AI platform.
Right. But again, what is that doing for you if you don't really know how to optimally use it? So, Andrew, to answer your question, uh, in certain instances, AI is no different than a standard POS. Okay. Again, it's different companies, different things. A lot of people are putting that AI sticker, to Chris's point, on things that are really not AI. Okay.
Mm-hmm.
Risks. Okay. We use AI, so I'm not an AI naysayer. Okay. We use AI in concert with other code in order to tease risks to the top of what we're doing or to expedite execution through our platform, without needing to have human touch at the more, you know, ABCD kind of completions, right? So I think that's important. I think as each organization gets to know real AI better, they should be building upon the foundation of where they started. You know, one of the things we did first with AI was really add additional automation to our draw advanced asset management component of our platform. You know, on, for example, ground up construction loans, construction to perm loans, fix and flip assets. There's draw advanced asset management throughout the life cycle of those loans. You know, draw requests are made, you know, inspections need to be ordered, inspections need to be reviewed. Then the draw amounts need to be confirmed. You know, instructions need to go to servicers or sub-servicers to send out the funds, or you need to send them yourself. So we use, you know, AI to really, you know, speed up those processes, take the human touch out of those things, because you're really, you know, it's like a connect the dots kind of thing, right? And the human really comes in at the end. And what it's done is it's increased efficiency, it's shortened the timeline to get these things completed. You know, the funds are getting processed faster, et cetera. Another place that we used AI as an example is I've always had a dashboard that auto refreshes, and so does my portfolio manager and the traders, watching our pipeline from a risk perspective of, you know, did the loan originally get locked with us as, you know, a primary residence or an investment property and then becomes a primary residence, this and that. Well, we enhanced that and made it more dynamic with AI, right? And there's a vast array of other things that we're doing. And as we continue to go through the different layers of AI, we're using it more and more. Right now, we're testing it on certain aspects of credit underwriting. And I like what I see in certain places and don't like what I see in other places. And then again, it's, you know, I'm not telling you that it's only as good as what you teach it because I've made up this idea. It's proven, right? We're continuing to teach it to get the right outputs. And I think those that are really doing the work on this stuff and living it have tested different solutions, have tried different partnering, et cetera, you know, really know that, right? And I think, you know, you should use it. The question is, where should you use it first, second, third, fourth? And then where is the risk palatable risk? And where is the risk money losing risk or regulatory violation risk? And that's where I think you need to, you know, really watch it and control it most.
I know Andrew talks a lot about build versus buy, but just based off of even what you're saying there, it's like it's not just something you just haphazardly, you know, built over the weekend or did over the weekend. It's like an active investment, an active it sounds like you have a team of people that are building this out and not just like you and like one other person that's going into like GPT or something like that and you know slapping together some tools. It's like an active build out. So I mean, Andrew, just to your point, this isn't something you can just kind of haphazardly do and just like, you know, expect it to work and, you know, not keep investing into it or updating it, things of that nature.
And candidly taking it out when it doesn't work, right? I
Yeah.
mean, you gotta be willing to do that. And look, I mean, the only way to get growth is to try and fail, right? I mean, anybody in the market, in the industry, no matter what silo they're in, anybody who's gotten to any level of executive management and tells you they have never failed is lying to you, right? So you need to, you know, you're going to go through the ebbs and flows of wins, semi wins, and losses, right? And losses, you know, can be some of the best things that teach you the most, right?
Right.
And I think that that's important, right? And to off-stave them is really, you know, that's really the skill set you want most often. You know, how do I off-stave risk and make the most money possible, right? I think that's should be the mantra of most humans. You know what I mean? In companies, quite frankly, and the AI.
Yeah. No, totally agreed. Okay, so real quick, because I feel like this question is going to take longer than they always do. Chris, we refresh my memory on what Katie King's question was from last week.
Yeah. So they were talking about how they went. So obviously, Jen, they went to the GSEs first before going to the non-QM jumbo space. Obviously, because of the lack of standardization in that area. And so their question was, what are your thoughts around standardization in that space?
Meaning underwriting in general, or which space?
I think that, you know, I think at least where their thoughts were is like, when I look at agency, right, you've got a governing body and you've got this, you know, whatever Fannie Freddie's, you know, portion of the market is, right? And like, when I'm underwriting a Fannie loan, I know what the income calculation requirements are. I know how cryptocurrency is treated, right? When I shift over to the non-QM, right, and I don't even know how many. I heard somebody the other day had 280 investors. I was like, my God, that's so many matrices. I want to just, I'm shaking.
Meaning takeout investors, 280 to sell to?
But something like that, yeah.
They don't. That many doesn't exist. But okay, I'm with you.
Yeah, but let's just even cull it down to 20, right?
Yeah.
And let's say I've got 20 takeout investors on the NQM side, right? That there is a lack of, you know, how do I underwrite a bank statement may look different across that, right? So there is no quote unquote, and for obvious reasons, there's no quote unquote sort of governing body when it comes to non-QM. And as a result, and this is where we come back, right? Gateless is largely machine learning. And when you've got a need to program so many different guidelines and update those guidelines, quite frankly, it becomes, I would argue, impossible to really have AI underwriting when it comes to, or machine learning, or whatever we're going to call it, in the non-QM space, unless you're programming each individual set of guidelines and then determining where is that loan being delivered.
So I'm going to say bullshit. And the reason I'm going to say bullshit is because the baseline of non-QM bank statement underwrite is similar, right? It's generally 12 to 24 months of bank statements. And then there are nuances across those that originate and also aggregate it as it pertains to expense, as it pertains to certain discounts that are then applied at the aggregate income output, right? So, you know, while I appreciate that there can be percentages or deviations, they are not so large that it makes up 300 different sets of guidelines. It is literally a back-end data table with an analysis, throw an investor code on it, and apply the deviations. It is not brain surgery.
It's not brain surgery, but it's also not easy when it comes to.
I think if you are an automated underwriting model user only that is not manually underwritten alone, then I'll agree that it's not easy. If you truly have the underwriting expertise to manually underwrite a loan, it's not hard because it is, in fact, a structure, right? There are absolutely bank statement underwriting tools that candidly can extract most of the information that you need to get to right out of the bank statements that you're using just by virtue of uploading them into an engine. And then the underwriter needs to make sure that the allocations are correct and that it meets the guidelines and apply those nuances that I mentioned, right?
Mhm.
But
Mhm.
and honestly, even if you were doing it in a spreadsheet and you didn't have one of those engines, there's only so many things that are income or expense,
Right.
right? And again, it's not that hard as long as you understand what the definition is for each component. So I think the real question was, do you believe that you could standardize non-QM? The answer is yes, you could standardize non-QM because it's not technically not standard today. There's just deviations by risk appetite across the investor spectrum.
Would you support like we have MISMO, so we've got data, right? A standardized mortgage data format. Would you ever support a standardized underwriting guideline or matrices format?
I mean, there is technically a standardized underwriting guideline and matrices. Think about what the top components are for originating any loan, right? Loan to value, debt to income, right? Back end and front end is debt to income, right? What is you need an appraised value. If it's purchase, you default to the purchase price. You see where I'm going with this? So
Yeah.
there is technically
Well, that's the underlying thing. I'm saying
every loan's got it or needs to answer it component. DTI, right? Yeah, it changes on, a DSCR loan, but it's really a property-based DTI. Why? It's principal, interest, tax, and insurance, and HOA, if applicable, divided by rent. It's the same thing. It's just property cash flow DTI. So when you think about it, that grid really does exist in all lending programs. It's how you get to the output that's different.
Right, but the problem is, and I think where Chris was going with this more so, is the actual format of it, right? So
Yeah,
you've got, and I'm not going to call out names, but there is one particular entity that decided they were going to build their own platform to create their guidelines, and apparently it will only put out like 3 or 4 columns, and so as a result, they have like 47 products because they can't actually expand the columns, right? So we look at a lot of matrices, right? It's one of the things we do for TPOs, and
But I think you guys are taking that as an issue in the market. That's an investor that doesn't want to give a finite answer and wants to make a decision at the loan level.
yeah, but but it does become more complex when you don't have a standardized format.
But some of them do it on purpose, is what I'm trying to explain, Andrew.
Got
right?
it.
Yeah,
Okay.
well, I
Right,
get that,
yeah.
but that's why I'm going to the question. Would you support some people saying,
Oh.
"Hey, we adopted this standard of doing that," and so we can call out those people who are like what do they say? Our money is in the complexity. Like, would you support? Hey, this is the. I'm not saying it's MISMO, but we use the MISMO matrices guideline.
Like I said, I don't actually think you're very far from that today. The numbers are just different in the grid.
Chris and I are going to disagree.
Now,
I want the
Chris,
grid to look the same. I want the grid.
At the end of the day,
No,
at the end of the day, right? At the end of the day, those nuances do exist for a reason. Okay. And yes, some are a competitive advantage, some are risk appetite questions, some are a pricing deviator, some are absolutely nuanced by virtue of execution. If you are selling a loan to go on an insurance company balance sheet, you're going to price differently than if you're going to securitization execution by virtue of just the cost, right? So you have to understand that unless you're going to take away liquidity possibilities for assets, you can't get to one standard model. What you would be doing in order to do that is narrowing the competition. And right now, the entire industry is screaming, give me more competition, not make it even stricter than it exists today. So sitting in multiple of those seats, I can tell you that a lot of it is just cost of execution and liquidity to begin with. Also cost of funds, okay? A bank balance sheet that can tap the Fed window or an insurance company, their cost of funds is materially lower than, for example, a REIT, a fund, et cetera. So a lot of it is also cost basis. So it's not necessarily just underwriting, it's also cost.
There you go. All right, we have run out of time, but Jen, as we always do, our guest has to ask next week's guest a question. The irony of this week is that I'm putting Chris in the hot seat next week as the guest. So you're going to ask the question. Chris is not going to answer it now, but he gets an entire week to decide what his answer is going to be.
No fair. I got 5 minutes. I feel like we should give it to him 5 minutes before the call. So I'm going to turn it around on you, Chris, and I'm going to say, tell me why you believe a standardized underwriting platform could work for all of the counterparties that raise capital to provide liquidity to the mortgage market.
Okay. Okay.
He's gonna need a week to research the answer.
I have my answer already, but I don't want to give it right now.
Wait.
Next week.
Ladies
We're going to see if Jennifer. We have to ask it last next week to make sure Jen watches the whole time.
I will absolutely show up for
You
that.
just fast forward to the end.
Again, guys, it's not meant to be a trick question, right?
No.
You need to know the nuances of each individualized counterparty and what their money is and where it comes from and whatnot in order to be able to do that. It's not just spread on rate. And you even see in lawsuits lately, you've seen stuff going margin. Well, guess what? Margin's not only determined on how much more money a lender is going to make, right? There's a lot that goes into these models. It's not as easy as it may seem.
Yeah.
No question about it. Jen, thank you so much. I really appreciate your time. If you're going to be out at MBA Annual, I know Jen will be out there running around. I'll be as well. But
Andrew, I'm sitting on the panel about how to actually make AI more human. So it is
I will have to steal someone's badge because I'm not registered. Hopefully MBA doesn't watch this.
No, guys, really, I enjoyed the conversation. Thanks. And listen, if you ever want to broaden on one of these topics, let's have a chat on that. We move so quickly through these hours, right? Let's really dig into some of this stuff and peel the onion back and see what we can. It says no one asked us. We might as well answer the questions that other people may or may not be asking.
I know. We could go forever. I could go forever with Jennifer. One of the things I want to ask Jennifer is that question: what is something people are not asking about non-QM? And then just like step back and be like, all right, we're just going to sit here for 30 minutes and let her go.
All right, we'll have to have you back, Jen, soon.
Yes,
right,
thank
guys.
you, Jen.
All right, ladies and gentlemen, next week, episode 24 with Chris Mace.
I will be there. Make sure I get the invite for that one. I'm looking forward to it.